time for the big three. 3 stocks, 3 charts, 3 trades. Rick Ducat will take us through the charts. Here to take us through the trades is Alan Nuckman, Chief Market Strategist at BullseyeOptions.com. Good to see you both. Thank you very much. Of course, we'll start off here with Ford, which really rolled off those F-150 Lightning yesterday, announced another electric truck came out with its quarterly numbers. Now what, Alan?
Well, I like the price action as far as the way that it's come back to its breakout point. Now, Ford had originally traded between 5 and 15 for 5 years, and then it broke out of the 15, which had a target of a 10-point move up to 25. So that has happened. Now it's come back down. Ford is down 30% now in 2022, but it's still up 170% in the last 2 years. So this is a secondary chance to get into the stock that obviously has had a strong trend, but you've seen some profit taking. So as a trader, I like it to come back to that breakout base, and you can use that as support, this 15-ish level. And the way I look to play it is with long-term options. So I'm looking at high probability positioning, and today's theme is in American stocks, and Ford is that play. The January $12 call is about $375, and it's $275 in the money. It's got 9 months of time. And if we just get to the halfway point of this drop from the top of $20, this option gains 100%.
Yeah, and I'll tell you, I was looking at some of the analyst reports. I saw $24 in overweight over at Wells Fargo, for example. So there is a lot of believers in this company on the bull side, on the bull case in this great American company. Rick, tell me your thoughts as you take a look at this chart.
Well, I chose to include Keltner channels today on my chart, which is similar to Bollinger Bands. And that is, Bollinger Bands are based on standard deviations away from a moving average. Keltner channels are based on average true range. So they both tell us something similar in that they show us when we're at extreme prices versus a fair value of prices. So more recently, looking at point A, we can see that we had 2 dips outside of these Keltner channels in recent weeks, but no real downside breakout the second time or the first time, really. In fact, the dip below recovered to close above that Keltner channel. And at the same time, looking at point B, we also saw a little bit of bullish divergence in the RSI. So the momentum situation is improving while price seems to be perhaps forming a bottom there. So I also highlighted point C, which is that $20 level Alan mentioned. I think there's some justification for that as well, because that was the point where we closed before we had this downside gap after earnings in January. So that seems like a reasonable spot to keep an eye on. These gaps can be filled oftentimes in trading.
And, it's interesting, just as you talk about, too, what we've been seeing in the trend in the market, right? The pressure's been on, so not surprised to see it pulling back a little bit. And those were great charts there, Rick. So, Alan, as you take a look at those charts and the highlights that Rick put on there, what stood out to you?
Well, I'm strictly a chart guy or price guy as well. So from a risk-reward standpoint, obviously this stock was a high flyer in relative terms, as much as Ford can be. But then it's relaxed. So I want to see another psychological buy-in here. And from a risk-reward standpoint, this in-the-money option that has 9 months of time, this stock substitution strategy, that lower strike that's in the money allows me to ride through all the ups and downs. Now, to get off the track of charts, but I know that's the subject, this is a stock that has a PE of 8. So it's very inexpensive in price and very inexpensive in those relative terms as well. So that $12 call gives us the right to be long from 12, and for me, that's a value trade as well.
Yeah, and you know what, Alan, I think you make a great point talking about the PE ratios, because when we take a look at other names, I mean, even people were talking about Amazon today that's getting crushed, right, but still, that it's still so expensive. And when you're trying to make your picks, Alan, and make your trades, just tell us quickly, what are some of the metrics that you look for?
Well, PE is like anything else, can always go higher. So it's relative. But when you're looking for something like I am with these American stocks for today's theme, that gives me a little bit of comfort in the fact that we continue to see earnings expand and earnings grow and prices go down. So the PE ratios in general for all stocks are actually getting better. So stocks are getting cheaper in relative terms than they were 6 months ago, a year ago, 2 years ago. So I find that to be a positive factor.
Understood. Okay. And I mean, and who doesn't love the F-150, right? If I gave you each an F-150 right now, I'm sure you wouldn't turn it away.
Exactly.
Or you'd give it to a friend. You'd find somebody who likes it. Let's move on because Rick has some great charts for us for your next name here, Alan Uckman, and that is U.S. Steel. We had a guest on yesterday who was picking a lot of the materials stocks. He liked them. Your thoughts on U.S. Steel?
Right. That's been the momentum sector in the market, has been the energies and the resource stocks. And so commodities in general. So U.S. Steel is up 325% in the last 2 years, but it is off of its top. It's about 20% off its April top. It's still up 65% in the last 3 months. So this has been a momentum mover. But if you look at the chart, it's been mostly between 20 and 30 until it had that breakout run, and that targeted a $10 move to 40. That happened. Now we've come back to that breakout, that top of the channel, that 30 level, which is a level to lean on. So I'm looking at a July 30 call. Again, that strike below where we're trading right now and in the money option. It's trading about 6 or so. Has 3 months of time, 70 delta, and a move back to that 40. This option gained 65%. So again, it's risk reward, and this is a strong stock that's stalled out a little bit as it's sorting out what's happening in the macro market. But I don't think any of the fundamentals have changed for the demand for commodities and resource stocks.
And what do you think here as you're taking a look? I mean, he has this bullish idea, Alan, for this trade on U.S. Steel. What do you think, Rick?
Well, strong is definitely a word I was thinking of, too, when I looked at this chart. I mean, right now we're up 32% or so on the year. And even despite the strength in the chart, we did see a dip below that lower Keltner channel. So what does that tell us exactly? This tells us that price is at a relatively extreme level versus some idea of fair value, which would be our middle line there, which is a 20-day exponential moving average. So, recently at point A here, we could be seeing just some consolidation after this big move up. It doesn't seem like the fundamental situation has changed. It doesn't seem like there's any real big warning signs on the chart. So looking at this point as well, we can see this white dash trend line that I saw off of those recent lows. We're right about at the point where the Keltner channel and the trend line are converging there. So that could be a pretty interesting support point if you're looking to make a long entry. We are falling off a bit today, though. We touched that 20-day exponential moving average near point B and retreated a little bit. So we were near some idea of that fair value point. Looking at point C finally, the upside point to watch is that top trend line, as it's also in confluence with the upper Keltner channel. And if we did reach that point, the Keltner channel, it's kind of a choice you make as a trader. We are looking for either a mean reversion move or a continuation move. And given the fundamental situation and the chart history, if we were to reach that upper Keltner channel, it would seem like it was more of a bullish move. And that's near that $40 level Alan mentioned as well.
Yeah, and Alan, do you think that's something that we could get to, that C level?
Oh, yeah, very easily. You've seen how we've seen some of these commodities have a big round of profit taking, but then they bounce back. It's happened in natural gas. It's happened, obviously, in oil. So you get these unwinds, but you use that as a second buying opportunity, and that's what I'm looking at here for U.S. Steel as well. So that 30 level on more of a weekly basis is something to lean on, but that's why I use options, so I don't have to be as precise. I have the right to be long from 30. I've got July, which is almost 3 months of time, and it's going to react very well if we move higher. Just a modest move, helps us option out dramatically, and that's the beauty of this stock substitution strategy, is that you're tying up less money and you're also getting great returns on just modest moves in the underlying stock. So it's a win-win situation, and I still think these commodities, as you've seen, they do have price pop potential all the time, and that demand equation doesn't look like it's going to alleviate anytime soon.
Okay. Well said there. And then last but not least, go into the retail space of the Gap, which obviously has several names under its umbrella, including Athleta and Old Navy and Banana Republic, and of course its namesake, the Gap. Alan, your thoughts?
Well, you'll agree that fashion is fickle, and it all comes full circle. So, if you look at the shirts in my closet, they're back in fashion when they had been out of fashion for 20 years. So everything comes back. So maybe Gap can do the same, and we'll have to see. But looking at it from a price standpoint, it's 60% off its May of 2021 high. Okay, so it's at a major discount. It's a big sale at the Gap. So it's dropped from 36 down to 11 over the last year. We see a bullish divergence at bottom, which is very big for me when we've talked about this in the past, where it makes new lows in the stock, but not new highs in the volatility. That's telling me that the sellers are running out of strength, and you could get a short covering bounce. Now, the midpoint of this drop from the top is 25. So that's kind of the upside target that I'm looking at. If you look big picture, Gap's been between 10 and 40 for the last decade. So the midpoint on that is also 25. So 25 is kind of a midpoint magnet as an objective if this can get going again. Now, I don't know when and where the fashion trends are going to change, but I'm looking at a January call, a January 11 call. 11 is the low. That 11 call is trading for about 3.25, and it's $2 in the money, a 70 delta, 9 months of time. So it all adds up to a high probability play, looking for the fortunes that change for the Gap and look for a turn in that stock.
And I think that, when you look at these turns and moves, some of them have been very dramatic. I mean, to see a 10% move or 15% move on the Gap on any given day can sometimes occur, particularly when there's news that they might spin off Old Navy, or they might have a buyer for Athleta, or, they seem to have a lot of headlines that move this stock pretty dramatically, and the supply chain issues really hitting them hard at this point. Tell me, Rick, as you take a look here at the Gap, what do you think?
Well, certainly much weaker than our previous chart. Kind of this long, thumping that it's taken as we've been trending down lower and lower here. We're down about 28% on the year now. However, this one is so beaten up at this point, I wonder if it's due for a bounce, because we did make some lows there near 13. We've slipped below them a little bit within the past week or so. That's where we're at with point A right now. So we had a big gap down recently, but what I noticed is kind of what Alan was saying too in terms of divergence. And I was looking at the RSI and momentum in line with price as well. So we had price that was relatively stable in terms of its lows. We had this gap down, but it recovered pretty quickly. And the RSI was holding up fairly well. It wasn't going down with price. And it also, even during this big gap, it did not go into that oversold area. So that looked moderately encouraging, perhaps if you had a more bullish outlook. Looking at point B next, an upside point to watch is 19, because that's near where price opened after a huge earnings gap down in November. And then also, I believe we mentioned that 25 level, and that represents near the top of the range from before the earnings gap, so that could be another upside target point.
Yeah. So what do you think of that as you look at that? To see those target points that he's talking about, Alan?
Well, the key for me is the time to recover. That's been the theme for all three of these positions today, but especially something like Gap. You don't know what the catalyst could be. It just suffered so badly over the last year. But you know how retail changes dramatically. And we've seen that in so many stocks that were, bad enough to buy, then they find a reason to turn, and people look at them as some sort of back in favor after being, something that no one wanted to touch. So I think that's important here. And I also think the strategy is super important. Is a limited risk option, not to try to pick the exact bottom of this stock, but try to find a gentle bottom with a long-term option. Again, January, gosh knows things are going to be a lot different between now and January in the macro market, in the world, and in retail. So, let's let the market sort things out. But I like the positioning, and that's what all these are, probability plays to be in position for success when these stocks come back.
Yeah, and the Gap has been one. Well, there are some names that seem to be the go-tos, like the Lululemon or Nike.
Right.
The Gap, as Rick pointed out, I mean, this chart really is a tough one in comparison to some of the others. I mean, just over 6 months, it's been beaten down, what is it, 40% or something, so 44%. So I think Rick did a good job showing that big move to the downside. So we wish the folks at the Gap and you for your trade some good news ahead. Alan Nuckman of BullseyeOption.com and Rick Ducat, a great job all week long doing the charts for us. Thank you so much.